Welcome to the Deep Dive. We break down complex corporate earnings so you don't have to.
We're here to give you the key insights.
Today, we're jumping into Campbell's Q4 and full fiscal year 2025 earnings call. It just happened September 3rd.
Yep. We'll unpack the numbers, look at their strategy for fiscal 26, and really size up the headwinds and tailwinds they're facing.
Exactly. There's a lot going on here, good execution in some areas, but, well, some pretty big challenges looming.
For sure. We want to give you, the listener, the full picture of what investors are looking at, especially with Campbell's talking about this bridge year concept.
Right. It's not just about the raw numbers, is it? It's the story behind them.
That's it.
Okay, let's kick off with a quick look at those Q4 results. Because, on the surface, there was some good news. Adjusted EPS came in at $1.62.
Yeah, and that beat the consensus of 57 cents, so a solid 5-cent beat there. Stronger earnings than expected, which is always, a positive start.
A good beat, definitely. But the top line, the revenue, that was a slightly different story.
It was, yeah. Revenue landed at $2.321 billion. That was actually a slight miss against the roughly $2.332 billion estimate.
Okay, so a beat on EPS, slight miss on revenue.
And while reported revenue was up 1% year over year, the really important number, organic revenue, that actually declined by 3% for the quarter.
Right, organic. That strips out things like acquisitions, doesn't it?
Exactly. So that 3% decline, it hints at maybe some underlying softness in demand, even if they mention shipment timing as a factor. It's sort of the first clue that things aren't entirely smooth sailing.
Gotcha. And what about EBIT, adjusted EBIT?
That came in at $321 million. And that was actually down 2% compared to last year.
Okay, so EPS beat, revenue slight miss, organic revenue down, EBIT down slightly. How did the market react to all this?
Well, it was interesting, kind of a mix. Shares ticked up in pre-market and kept climbing a bit in the early session. Trading volume was way up too.
So some optimism, but maybe cautious optimism.
I think that's a good way to put it. Cautious constructive. People liked the Q4 beat, but the guidance for next year, which we'll get to, definitely gave investors pause. The market seems to be in a bit of a show-me mode.
Makes sense.
Yeah.
Okay, let's dive deeper then. Those headline numbers only tell part of the story, right?
Absolutely. Let's look at the details from Q4. Adjusted gross margin was 30.5%. Now, that's down 90 basis points from last year, almost a full percentage point drop.
Ouch. Why the drop?
Well, and this is key. About 30 basis points of that drop, so a third of it, was directly because of tariffs.
Tariffs again. We're going to hear that word a lot, aren't we?
I think so. It's a major theme. And it hits right at the gross margin level, even before other expenses.
Speaking of expenses, what about marketing and selling? Were they pulling back there?
Actually, no. They spent about 9% of sales on marketing and selling. That's up 5% year over year on an adjusted basis.
So they're investing more, even with margin pressure.
Seems like it. Management framed it as, strategic investments needed to connect with consumers and drive future growth. So maybe sacrificing a bit of margin now for later gain.
Okay, let's broaden out to the full fiscal year, FY25. How did things look overall?
Pretty solid on the cash flow front. They generated $1.13 billion in operating cash flow for the full year.
That's strong. And capital spending?
Capital expenditures were $426 million. That was actually down 18% from the year before.
Okay, so disciplined on CapEx. What about shareholder returns?
They did return cash, $62 million through share buybacks, and paid out $459 million in dividends. Remember, they also had that 5% dividend hike kick in during Q3.
Right. And importantly, what about debt? Leverage?
Good point. The net debt to adjusted EBITDA ratio actually improved. It went down to 3.6 times at year end from 3.7 times in FY24. So they are making progress on deleveraging, which is, a positive signal of financial health.
So summing up FY25, reported sales up 6%, mostly thanks to the Sovos acquisition.
Right, the Rouse deal.
But organic sales, stripping that out, were down 1%. Adjusted EBIT up 2%, but adjusted EPS actually fell 4% for the year to $2.97.
Exactly. And that Sovos acquisition, it really performed well. The Rouse brand delivered high single-digit net sales growth on a pro forma basis.
So it really is a tale of two companies, isn't it? Mm-hmm. The acquired parts are doing great, while the legacy organic business is facing more challenges.
That's a perfect summary. And Rouse, wow, it's getting close to being $1 billion brand. That's pretty remarkable.
Incredible speed. Let's break it down by segment then. Where did things really shine and where were the struggles? Meals and beverages first.
Meals and beverages was definitely the strong point. It kept its momentum, actually grew faster than the category overall, and gained 0.2 share points.
Nice. And Rouse pasta sauces specifically.
Back to high single-digit consumption growth in Q4. It's clearly the growth engine right now, showing they integrated it well, and it's meeting that consumer demand for, premium, tasty options.
Was it just Rouse, or did other parts of that segment do well too?
No, others performed too. The broth business was strong, up 7% in consumption. They had some neat innovations there, like Swanson's first ramen broth and new Pacific-flavored bone broths, ginger, turmeric, that kind of thing.
Oh, interesting. Keeping things fresh.
Yeah, and even condensed soup, the classic Campbell soup, that actually achieved its 7th straight quarter of dollar share growth. So strength across the board in meals and beverages, from premium down to the core.
Okay, solid performance there. Now, what about the other side, snacks? How did that fare?
Snacks, still facing some headwinds, but the good news is it did show sequential improvement. Both net sales and in-market consumption ticked up from the previous quarter.
So not growing year over year, but getting better.
Exactly.
Yeah.
Overall consumption was still down 2% year over year, but that sequential improvement is, a positive sign. Things are moving in the right direction, albeit slowly.
Was innovation a factor there?
Definitely. The Milano white chocolate line apparently was a huge hit. It drove a 27% jump in Milano dollar consumption in Q4.
Wow, 27%.
Yeah, and it lifted the whole Pepperidge Farm cookie category by 3%. Management called it the #1 driver of growth for the category, both dollar and volume. So innovation really can move the needle.
Absolutely. But what about the big one, Goldfish?
Goldfish. Well, it also showed sequential improvement in dollars and share, but management was pretty clear it needs more help, more marketing support, more strategic promotions to get it back to its usual growth trajectory.
Okay, so Goldfish is a key area to watch for you, the listener.
Yeah.
How they try and reignite that brand.
For sure. And also the better for you Kips like Kettle and Late July, they also improved sequentially and gained some share. So pockets of strength even within snacks.
All right, so that brings us to the strategy and the guidance for fiscal 26, which, as you said, they're calling a bridge year. What's the plan?
A big part of the plan is hitting costs hard. Through their peak program, they announced a major increase to their cost savings target.
Now, major.
They're now aiming for $375 million in savings by the end of fiscal 2028. That's up from $250 million previously, a 50% increase.
Wow, that's a huge jump. Is that realistic? Or maybe a sign they need to cut that deep?
Well, they say they've already delivered about $145 million in FY25, mostly from Sovo synergies and optimizing manufacturing. So they have made progress.
And where are the future savings coming from?
They highlighted 4 areas. Network optimization, so plants, warehouses, logistics, more integration savings, especially from Sovo's ERP and back office stuff, tech and organizational changes, and managing indirect spending better.
Okay, a multi-pronged approach. How much do they expect to get in FY26?
Around $70 million in savings next year.
All right, so cost savings are a big lever. What about the actual guidance numbers for FY26? Remind us of those, based on a 52-week year.
Right. Organic net sales, basically flat, projected between -1% and +1%.
That's flat sales.
Adjusted EBIT expected to decline significantly, down between 13% and 9%.
Oof, that's a big drop.
It is. And adjusted EPS forecasted between $2.40 and $2.55. That's an 18% to 12% decline year over year.
Okay, wow. So after a decent Q4 beat, guiding down that much on EBIT and EPS for next year, what is driving that? What's the main culprit?
Tariffs. Plain and simple. It's the overriding headwind. They estimate tariffs will account for about 2/3 of that adjusted EPS decline at the midpoint.
2/3 just from tariffs. That's massive. How does it actually impact them?
It's expected to hit their cost of goods sold, their COGS, by about 4% gross impact. That's a huge direct hit to profitability right off the bat.
Where are these tariffs coming from specifically?
Roughly 60% are the Section 232 steel and aluminum tariffs. That mostly hits meals and beverages, especially, the tin plate they need for soup cans.
Right, the actual cans.
Yeah. Think about it. A basic product like soup hit by tariffs on the can itself. The other 40% or so are mainly global IEPA tariffs. Those affect imported stuff like Rouse, which is made in Italy, and other raw materials.
So it's hitting their core products and their growth engine. Rouse, a double whammy.
Pretty much. It's coming from different angles.
So what can they do about it? They mentioned the cost savings, but are there specific strategies to fight these tariff impacts?
They're aiming to mitigate or offset about 60% of that gross tariff impact in FY26.
Okay, 60% mitigation.
How? It's not one single thing. It's a mix. Managing inventory carefully, working closely with suppliers, looking for alternative sourcing.
Can they actually find alternative sources for things like tin plate or Rouse sauce?
Well, they acknowledge that's challenging, especially for food-grade tin plate and the specific quality needs for Rouse sauce, plus limited domestic options. So alternative sourcing might be tough for some key inputs.
So what else is in the mitigation plan?
Enhanced productivity, so getting more efficient, and also some targeted surgical pricing actions.
Ah, pricing. So passing some of it on to the consumer, but carefully.
Sounds like it. Surgical implies they won't do broad increases, but targeted ones where they think they can. But yeah, this whole combination of things is needed to hit that 60% mitigation target. It really highlights how sticky this tariff problem is.
It really sounds like a strategic juggling act. Cut costs here, try to mitigate tariffs there, but also you still need to invest in the brands, right?
Exactly. Which is why they're calling FY26 a bridge year. They're focused on getting through this tariff mess, banking the cost savings, investing in brands, all hopefully setting up for, as they put it, a cleaner growth setup in FY27.
Makes you wonder how much is strategic planning versus just managing expectations down because of these unavoidable tariffs?
It's a fair question. But they are looking beyond the immediate pressures. They're actively trying to align the portfolio with what consumers want.
Like what?
Well, one notable thing is they committed to eliminating synthetic food dyes, FD&C colors from all their food and drinks starting in FY26.
Oh, interesting. Responding to health trends.
Yeah. Management talked a lot about trends like more cooking at home, people wanting more flavor and premium experiences, and definitely that health and wellness focus.
And they're backing that up with spending. You mentioned marketing earlier.
Yes, marketing and selling expenses are expected to actually increase as a percentage of sales in FY26 to between 9% and 10%. So they're putting more money behind the brands to support these trends, not just hunkering down.
Okay. And how is this all expected to play out during the year? The phasing.
They expect organic net sales trends to get sequentially better than Q4 was. But Q1 of 26 will still feel some pressure, partly from the ongoing snacks recovery and also some promotional timing shifts in meals and beverages.
So don't expect miracles in Q1. When do they see snacks stabilizing?
Anticipated in the second half of FY26. And the operating margin pressure, that roughly 150 basis point hit at the midpoint, they expect that to be pretty consistent throughout the year.
Okay, so a tougher first half, hopefully improving later. Good to know. Let's connect this to the bigger picture for investors listening. How does Campbell's fit into the whole consumer staples sector right now?
Well, the whole sector is dealing with similar issues, right? Tariff costs, inflation still lingering, and consumers being pretty cautious with their spending.
Yeah, value is key.
Exactly. The call really reinforced that shift we're seeing towards value, but also towards health and wellness and people still cooking at home more than pre-pandemic. So Campbell's isn't alone in facing this environment.
But they do have specific levers they're pulling. Yeah. Strong brands like Rouse heading towards $1 billion. They're investing in innovation, like those better-for-you options, new flavors.
Right. And that huge ramp up in the cost savings target to $375 million, that shows they're being really aggressive in defending their margins against all these external hits. They aren't just sitting back.
So for an experienced investor, it really boils down to balancing that solid Q4 execution, especially the EPS beat and the meals and beverages strength.
Against that really significant near-term headwind from tariffs, which again drives 2/3 of the guided EPS decline for FY26. It's a real tug of war.
So what are the absolute key things you, the listener, should be watching?
Definitely how well those tariff mitigation plans actually work. Can they really offset 60%? Second, the pace of recovery in snacks, especially getting Goldfish back on track. And third, can Rouse and the rest of Meals and Beverages keep up their momentum?
And this whole bridge year narrative for FY26, it really sets up FY27 as the year things are supposed to look cleaner. It's a big test for management's execution.
It absolutely is. Can they navigate these macro pressures while hitting their internal targets? That's the question.
All right, perfectly sets us up for our This Is Not Financial Advice segment.
Yeah.
Given everything, the bridge year, the headwinds, the cost cuts, the brand strength, if you were pitching an idea to a hypothetical investment committee, maybe one with a taste for volatility, how might you play this?
Okay, well, keeping firmly in mind this is not financial advice. Given that mix of low expectations from the guidance, the big external risks like tariffs, but also those strong internal moves like the cost savings, I might propose something like a long straddle.
A long straddle, buying both a call and a put option. Explain the thinking there.
Right. Specifically, maybe looking out to the January 2027 expiration, so giving it time to play out past this bridge year, and setting the strikes slightly out of the money from where the stock is trading now.
Oh, why that structure?
Because management has set a pretty low bar for FY26, blaming tariffs heavily. Plus, they've announced that massive cost savings target. It feels like a potential under-promise, over-deliver setup.
How so?
Well, what if trade policies shift? Or what if their tariff mitigation is way better than 60%? Or maybe reigniting goldfish and pushing Rouse works even better than expected. If any of that happens and growth surges beyond just stabilization, the upside could be significant. The call option covers that.
And the downside protection, or rather the bet on the downside.
Conversely, what if those mitigation efforts just don't work as planned? Or if consumers really pull back because of pricing or just general caution, hitting volumes harder than expected? The stock could easily fall further, maybe retest those lows from the past year. The put option covers that scenario.
So you're not calling a direction up or down. You're betting on a big move, one way or the other.
Exactly. The straddle profits from significant volatility. We're leveraging the low expectations for FY26 against these big structural changes and policy risks. It's about capturing an outsized gain if there's a surprise move, up or down. Basically, betting on this inflection point leading to a decisive break from the current price range.
Interesting. Buying volatility around a period of high uncertainty. A provocative idea indeed. Again, folks, purely hypothetical, not advice.
Absolutely not advice, just exploring possibilities based on the setup.
Okay, let's wrap this up. To recap, Campbell's put up a strong Q4, beat EPS estimates. Meals and Beverages showing real momentum, snacks stabilizing but still needs work.
But the FY26 guidance is definitely cautious, heavily impacted by projected tariff costs. They're countering with aggressive cost savings, aiming for $375 million by FY28, and still investing in innovation and brands.
The market reaction seems cautiously optimistic, acknowledging the execution, but wary of the headwinds. Key things to watch: tariff mitigation effectiveness and the snacks recovery, especially goldfish.
And remember, all the information we discussed today is just for informational purposes. It is absolutely not financial advice. Please always do your own research.
So for you, the listener, as Campbell's heads into this FY26 bridge year, the big question remains: can these aggressive internal actions truly overcome the external pressures and set up that cleaner growth for FY27? Or are the headwinds just too strong? That's the puzzle investors will be watching closely.
Indeed. Join us next time on The Deep Dive for more earnings insights.